Okay, I'm good now. Whew. Okay, it's 10:01. So let's go ahead and get started. We still have folks in the waiting room, but Bianca is letting them in for us. So we will get things kicked off. Just a couple of reminders as we get started. This is set up as a Zoom meeting. So I just remind you all to mute yourself. We will be taking questions throughout the event. Please share them in the chat. And then around 10:45 or so, we'll take a break and we'll start to address all of those questions. Also, we'll be recording the session and we'll share that along with the slide deck with you after. But before we dig into all the great information we have for you, we have some VIPs to thank, and those are our 2024 corporate sponsors. They include our platinum sponsors, InterSolutions, Residency Bureau, and Tetfer Construction. Then we also have our 2024 gold sponsors. They include American Pest, Brothers Paving and Concrete, Capital Canopies, Electronic Security Services, Hawkins Electric, Minkoff Company, JB Klein, Multi Housing Depot, Planned Companies, and PotholeRepair.com. And then last but not least, we have our silver sponsors. They include Berkshire, Donaldson, Finley, Orndorff and Spade, PC Richard and Son, Quest Insurance, Rain and Son, Thomasville Restoration, and TRC Engineering. Our corporate sponsors put a lot of time, energy, and resources into supporting all that PMA does. And I strongly encourage all of the property management professionals on the phone to keep these companies top of mind when they're in the market for new products and services. And I just wanted to make you aware of several upcoming events that we have, starting with Activate PMA. We will be coming together next Thursday, January 25th, at the Hilton Washington, D.C. Rockville Hotel in Rockville, Maryland. At that event, we will have Paresh Shah, who will be there to speak to us about how we can elevate and activate our leadership skills. And an important thing to note, leadership isn't about a title, if you will. You don't necessarily have to be striving to climb the corporate ladder to want to grow your leadership skills. Anybody who can affect change and affect outcomes in their life, whether personally or professionally, is a leader. And Paresh is a high energy speaker who will give you the tools you need to achieve further success. And then we have a ton of in-person education coming up on our calendar. We have Crafting Your Professional Identity, a guide to successful personal branding, scheduled for Thursday, March 21st, and that will be at the Hilton Arlington National Landing. And on Thursday, April 18th, we will have our in-person 2024 Leasing and Maintenance Summit. That will be at Martin's Crosswinds in Greenbelt, Maryland. We'll be meeting in person for Financial Fundamentals, Mastering the Basics of Financial Analysis on Thursday, May 16th. That session will be in the morning, and then in the afternoon on that same day at the same location, we'll have Advanced Financial Management, Optimizing Property Performance for Managers. So save the date for all of those sessions, and online registration will be open for them shortly if it's not already. And then it looks like I had an issue with my font. I have some white font here. You can't see what's happening on Monday, May 20th, 2024. But you know what it is? It is our summer escape. It's our annual golf outing, and it's a golf outing on steroids. We will also have a tasting of some sort. We're working through the logistics of beer and wine and all of that good stuff, but we'll have great networking happening at Lakewood Country Club in Rockville, Maryland on Monday, May 20th. Again, that's the summer escape. And then on Thursday, August 15th, we will be coming together at Smoky Glen Farm for our annual lobster bake. That will be in the afternoon on Thursday, August 15th. So save the date for that as well. So now that you've heard all about all of our upcoming events and programs, let's talk about what we have in store for you today. We have Michael Cobb Jr. here with us, and he is a market analytics director at CoStar Group. And in his role, he identifies analytical trends throughout several mid-Atlantic and Southeast metros. He's written several articles and reports, and he presents on market conditions to industry participants of all types, providing specific granular analysis down to the site level. So we're excited to have him here today to share with you some of what we saw in 2023 and some of what we can look forward to in 2024. And Mike, I'll turn it over to you.
Awesome. Thank you very much, Sarah. I appreciate it. And thank you to everyone at PMA for having me today. I look forward to interacting with you all over the next hour or so as we take a look at what's going on in the state of the Washington multifamily market. Obviously, all of you have boots on the ground and are in all of this data every day and seeing it firsthand. Quite a bit has changed over the past 4 years. I don't think that's any surprise to anyone. So the goal over the next 40 or so minutes is to take a look at what got us here, what's been happening more recently, and then what are some things to look out for over the next 12 months and even going into 2025 and 26 later on, just so we can set the stage for some changes that might occur. We're going to be covering quite a bit of ground over the next 40 minutes. There's going to be a lot of slides. Some of them are going to be longer than others, and others are going to be quick hitters. So there are going to be some that we go through pretty quickly. Don't fret. Everyone is, I'm happy to send this presentation out. I'll send it to Sarah afterwards, and my contact information will be there at the end. So feel free to put questions in the chat. We can go through those at the end and go back to different slides and stuff like that. Or if you prefer to have a one-on-one afterwards, more than happy to do so. So, in terms of an agenda today, here's what we're going to cover. We're going to start out with a quick economic update. Nothing too major or groundbreaking or anything like that. We're just going to take a high level look at some things that have been taking place from a population standpoint, a job growth perspective, and also some trends that are interesting from a demand perspective. From there, we're going to take a look at how DC compares and the Washington Metro compares to other markets and get its performance relative to others. And then we're going to take a look at Washington specifically, looking at supply, demand, rents, all of the core fundamentals of the market to see how things are trending. And then the last two pieces of it will be a quick look at the capital markets, seeing what sales activity is done, what are the biggest changes taking place. And then we'll wind up with an outlook, taking a look at what do things look like for the future. So we're going to hit on these 5 topics over the next 40 or so minutes. So sit back, relax, and we'll go through this over the next 40 minutes. So the first thing I want to do is a little bit of housekeeping. And anytime you hear me say the Washington Metro, we follow the MSA level. So we're looking at a pretty broad geography. So not just DC proper, we're not just DC, Arlington, Prince George's, Montgomery, et cetera. It's a wide geography going as far north as Frederick County, as far south as Spotsylvania. So a lot of geography to cover here. We're going to take time to dive into different geographies, submarkets, things like that. But anytime you hear me say Washington, we're referring to this whole area. So just keep that in mind so that we're on the same page when we're discussing the market itself. So first thing we want to do is dive into the economic update of things. And one of the biggest things in the most recently released data is the population change on the state and district level. Now, from a methodology standpoint, the Census Bureau releases the state level data before it does county level data. So in about 2 months or so, we'll have an idea of what's been going on from a county to county perspective, which I think is paramount to understanding population flows in and around the Washington area and what that means for multifamily demand. We can gain a little bit of that from looking at the state level, but obviously, when it comes to Maryland and Virginia, we won't get the whole picture because we don't know where within the state people are going and things like that. But the biggest take home here is that when you look at DC, it grew by 1.2% year over year as of the most recently released data. And this is a mid-year to mid-year calculation. Population growth by the Census Bureau is calculated from June of one year to June of the next year. So basically, this is looking at it and saying, what is the population at the end of June 2022 to the end of June 2023? And what you can see is that DC grew by 1.2%. That's an impressive number when you look at what it's joined by in terms of the other states in and around there. You look at your Texas, Florida, South Carolinas, North Carolina's, a lot of your Sun Belt fast growing metros that are growing by anywhere from 1.3 to 1.7%, and then see DC right there. That's an impressive growth rate for the district. And just to put this into perspective, what this is a lot of returning individuals and renter households or potentially owning households back to the district. Because when you look at DC's population ebbs and flows, as most of you know, when you saw it in 2020, it declined by about 37,000 individuals. And then in 2021, it declined by about 2,000. And then in 2022, it grew by about 3,000. And then most recently, it grew by about 8,000 individuals. So it's going on that up and down swing of a lot of those individuals that flocked out of the district in the early months and quarters of the pandemic have since made a return. And ultimately, that's been a positive for apartment demand in and around the area, especially given all of the units that have been opening up within the district proper. Now, when it comes to Maryland and Virginia, pretty low numbers of population growth. Maryland, it's hard to get a takeaway from this and understand where it is because, when you look at places like Prince George's County or Montgomery County, those grew a ton in the early months of the pandemic. And from anecdotes, and I'm curious to hear what you guys are seeing, a lot of those DC based individuals flocked outward and have now returned back to the district. It's not a complete replacement by any means because, when we talk about the DC numbers growing by 8,000 individuals last year, but declined by 37,000 3 years ago, it's not back to it. But it'll be interesting to see what happens in Prince George's and Montgomery County, and particularly Frederick County. Frederick County was the fastest growing metro from a percentage standpoint from 2020 to 2022 because you had so many individuals flocking northwest up the 270 corridor looking for affordability for those that don't have to be in the office the entire time. Virginia is also an interesting one because Northern Virginia has been a boon for population growth, not only over the past 4 years, but over the past 5, 10 years. So seeing where a lot of these pockets go will be interesting. But the big takeaway here early on, before we get the county growth, is that DC has been seeing more and more growth over the past 2 years after a pretty, rough stretch from 2020 to 2021. So a positivity from a population standpoint. When it comes to job growth has been mostly positive in Washington. What this is looking at is net job gains or losses on a month-over-month basis since the recovery began. So basically, we're looking at this from May of 2020. And the reason we do that is because if we included the losses from March and April, the scale would be so negative that we just want to look at what the recovery has done. And by and large, what you're seeing here is that it's been mostly positive. In fact, when you look at these, there are pretty consistent blips on the radar in the January of each year and then right around June or July of each year. Those are pretty normal and those are expected. So those aren't catastrophic losses that came out of nowhere. Those are expected. And so what I mean by that is, let's start with January of each year. What you have there is in the later months of the year, you have a lot of seasonal hiring that tends to be temporary in order to staff up for the holidays. Once those jobs are no longer needed, they come off of payrolls in January of each year. So job losses in January are pretty normal, and that's not unique to Washington. That happens in a lot of places. Same thing in the beginning of the summer. What happens there is a lot of teacher payrolls come off as they're on payrolls for 9 months, and then when the summer hits, they come off, and then they come back on in the start of the school year in either August or September. So by and large, outside of those, job growth has been mostly positive, and what you're seeing here is that DC, or excuse me, the Washington Metro's total non-farm payroll reached its pre-pandemic level in late 2022 and has remained there really ever since. So we are above where we were in early 2020. That doesn't mean that every single pocket of the local economy has recovered because different industries have trended, more positively or more negatively than others. But as a whole, job totals are back above pre-pandemic levels. The interesting thing to think about here, though, is when you look at this on a 12-month trailing basis, Washington's total non-farm payroll increased by about 44,000 jobs at the close of November, which was the most recently released data set. That number has been slowing over the past year to 2 years. Now, one thing to say there is that when you lose so many thousand jobs in the early onset of the pandemic, of course you're going to have, a higher number because they have to be added back. But it's continually slowed over the past 12 months and it's been coming down. What I will add is that when you look back to the early 90s, DC's long-term growth rate is about 30,000 jobs, 30 to 33,000 jobs added on a 12-month trailing basis. So we're still above that, but this slowing has been important because there's a lot of it's sort of a polarizing topic, right? Whether or not we're going to be in a recession in the coming months. Oxford Economics calls for job growth to slow to essentially a crawl by the later portion of this year. And what we're seeing is that slowing taking place. Obviously, if that does continue, that will impact household budgets, demand for housing, and things like that. So it's something to keep in mind and keep an eye on as we move through 2024, what that might look like. The last economic update slide we want to take a look at is metro ridership. And it's no secret that metro ridership had been declining leading up to the pandemic. You can see that from 2012 to 2019, that slow crawl downward. But the big thing here is when you look at this, and this is looking at weekday ridership and average monthly riders. So we're not looking at any weekends or anything like that because we just want to get an idea of what it looks like from an employment perspective. How many people are riding the metro on a daily basis during the week as compared to pre-pandemic norms. And the takeaway is that by the end of the year, it was about 40% below 2020 levels. So it's clear that while it's increasing, it's not anywhere near where we were in late 2019 and early 2020. So it goes to show that, office using trends are still quite different compared to where they were 4 years ago. And a lot of that has impacted the flow of renter demand to different geographies. For those that don't need to be as close to the office as they might have been previously, that's why you're seeing some more outward growth to the suburbs and potentially less in the district itself. Now, that isn't saying that, there is this mass exodus from the district, because as we saw at the beginning, we've seen an increase in population growth, but it's something to keep in mind in terms of what demand might look like as office using decisions are changing over the next, call it 4 to 12 quarters. So now that we've taken a quick look at the economy, let's dive into the multifamily market, and we're going to spend more time on, supply, demand, vacancy trends, et cetera. The first thing we want to look at here is the Washington Metro's fundamentals. And many of you have likely seen this chart before. For those of you that haven't, I'll explain it since we'll look at it a couple times. What we're looking at here are a couple things. First, the orange bars represent your quarterly change in demand. That's the change in occupied units quarter over quarter. So move-ins minus move-outs. This is not a leased percentage. This is a physically occupied percentage. So that's the orange bars. The blue bars are your quarterly change in supply. That's any new supply minus any conversions or demolitions. And both of those bars correspond to the right axis as shown in intervals of 1,000 units. Overlaid on top of that is the green vacancy rate. That's a non-stabilized rate. So that includes properties that have been open for a day. It's properties that have been open for 5, 6 decades. It's everything. So what's been the takeaway here? Well, by and large, vacancies were essentially flat throughout 2023, which can be seen as an impressive thing. And I know there's a lot of volatility with this slide, a lot of change and things like that. But if you focus on the far right side, what you'll see is that vacancies essentially started and ended the year right around 7% in Washington. And sure, that is above pre-pandemic norms, but it's very much a supply story in Washington. In fact, by the close of 2023, you had more than 10,000 units open their doors for the 10th year in a row. In fact, that total exceeded 12,000 units for the 5th year in a row. That's a lot of units. In fact, when you look at the 10 years leading up to that streak, so pre-2014, the annual average was about 6,000 units. So we're dramatically changing the landscape, going from 6,000 units on average to those 10 years to an average of 13,000 units over the past 10 years. It continues to be a supply story, and it's a matter of will demand keep pace. By the end of the year, nearly 13,000 units were absorbed. So it was a very positive year, especially compared to a pretty low year in 2022, and demand increased by about 50%. But that's the biggest question and the biggest crystal ball right now is what will demand continue to do, because supply additions aren't necessarily letting up anytime soon. When you look at Washington and compare it to the 40 largest markets across the country, it's actually a pretty healthy rate relative to its counterparts at just over 7%. What you'll see there is it's on the bottom half of that list in terms of bottom half being some of the tighter markets, and it's joined by a lot of what you might deem to be sort of Midwest, Mid-Atlantic, Northeast markets that haven't seen quite the population growth that you've seen in the Sun Belt or faster growing markets like that. A lot of these markets are also a little bit more landlocked and not seeing as much supply impact. So on the other hand, when you look at, in the top left in Austin or Raleigh or Atlanta or Nashville that have seen just a tremendous wave of supply, it's ultimately resulted in a lot of vacancy expansion there because it's just hard to keep pace with the sheer number of units that have been opening their doors. That's not to downplay the number of units that have been opening in Washington, but on a percentage basis, we'll look at it in a second, in 2 slides from now. It's much more tame than what you're seeing in a lot of other markets, which has ultimately been of benefit. And we'll talk about that when it comes to demand as well. In fact, when we look at these same markets and see where vacancies have gone within each market over the past 4 years from 2020 to 2023, Washington's vacancy rate, although we have seen a lot of changes on a quarter over quarter basis, and it's not just like vacancies have slowly tricked up, a half percentage point over the past 4 years, from point A to point B, vacancies have only gone up by a half a percentage point. So all things considered, when you've had nearly 55,000 units open their doors over the past 4 years, an unparalleled level of economic turbulence and a lot of changes from a population standpoint, for the market to only see its vacancy rate go up by a half a percentage point can really be seen as a positive for the market. In fact, when you look at a lot of these high growth markets in the top left and left hand side, you'll see 4, 3, 2 percentage point expansions over that time frame. DC's been nowhere near there. So sure, within Washington itself, there have been a lot of concerns, particularly in different pockets of, higher vacancies and things like that. As a whole, the market has been pretty steady over the past 4 years, albeit, through the troughs and the changes that have taken place. And the big part of that is because when you look at the supply aspect of things, what this chart is showing is the percentage of inventory increase since 2020. So, for example, Washington's multifamily market has seen its inventory grow by nearly 11% over the past 4 years. That equates to, about 54,000, 55,000 units. When you compare that to a lot of others, again, look at that top left. A lot of those Sunbelt markets that are going by 25% in a four-year span. It's hard to keep pace with a lot of that level of supply. And a lot of these markets are seeing a lot of change over the past 4 quarters in that vacancies are expanding significantly, rents are declining quite precipitously, whereas, in DC, that hasn't been the case. So we'll talk about that when we get into the rent section. But ultimately, just as we put that into perspective, sure, it's been a ton of units opening their doors in Washington over the past 4 years. But, when you compare it to a lot of other places, it's somewhat of a middle of the pack rate from a net percentage inventory expansion rate. So a lot of supply. And when we compare that in terms of what that's been doing from a vacancy perspective, and we break out Washington a little bit more, what you'll see here is we have 3 buckets. We have Northern Virginia in the yellow, we have suburban Maryland in the green, and we have the district in the blue. And what you'll see here is that really for the past 12 years or so, DC has historically had a higher vacancy rate than its suburban counterparts. That can be expected though, because it has a smaller inventory than its counterparts and has been seeing a lot more supply growth than its counterparts. So when you have more supply and a smaller inventory, that impact, particularly from a units in lease up perspective, has led to vacancies remaining several percentage points above both Northern Virginia and suburban Maryland comparatively. But there are a couple changes most recently. If we ignore, the significant spike that we saw in 2020 and 2021 and just focus on 23, what you'll see here is that there was a great amount of vacancy compression in the district itself in 2023. And when you think about the population figures we talked about at the beginning, it starts to lend a hand to what we've been seeing in terms of a return to DC and from a renter perspective and, sort of an increase in lease up. While vacancies have gone from 9 to 8%, and that's above historical norms, it's a differing trend than what we saw in 2020. On the other hand, suburban Maryland has been going in the opposite direction. In fact, by the spring of 2022, vacancies were essentially at low 5%, which was a 15-year low rate in the suburban Maryland piece of things. But ever since then, vacancies have gone up to a low 7% rate. So increasing by 2 percentage points in about a year and a half is pretty significant. And what we're seeing there is continued softness from a demand side, particularly within that Class B, Class C renter cohort, that renter by necessity that has been more affected financially over the past 4 years than your, above average household income earner. And at the same time, you've seen more supply deliver. So when you put those into the same bucket, it ultimately lends its hand to lower demand and more supply. Now, you're probably thinking, well, those renters don't rent, any of the new supply in general. You're right. However, when you add them together, that's why you're seeing diverging trends. And we'll talk about that more in a couple minutes when it comes to different star buckets. But that's really been the big story there is softening demand on the more affordable side on the suburban Maryland piece with an influx of new supply, creating that imbalance from a vacancy perspective. To round out the trio, Northern Virginia has been very stable. When you look at Northern Virginia, it's kind of hiding there at the bottom. It's been very consistent between that 5-6% range for the better part of the past 2 years, despite the fact of all the new supply that's delivered there. And it's really owed itself to the population growth that's been there. Moreover, Northern Virginia tends to have a lot more of a company base in which you have sort of national firms, expanding tech firms that have a higher um, percentage of individuals that'll work from home on a more consistent basis. And what that means is it lends its hand to more apartment demand for those that, excuse me, have not entered the single family realm or just do not wish to enter the single family realm. So ultimately, Northern Virginia has been the most steady of these 3 parts of the metro over the past 2 years. And just to give you an idea of what vacancies look like, there's a lot going on this slide, and we won't go into each and every one by any means. But what this is looking at is any submarket with at least 1,000 existing units and what the vacancy rate was at the close of 2023. And what you'll see here is that some of your supply heavy submarkets continue to be at the top of that list. When you look at H Street, Noma, and Southwest Navy Yard, we'll talk about them in more depth in the next section in a minute here. But when you talk about supply, those two have been the hot pockets of supply, for lack of a better term there, of supply over the past 4 years. And it's really just trying to keep up with the new units that have been opening their doors. Potomac is just barely over the 1,000 unit mark. And I'm sure all of you are looking at it saying, well, that's mostly single family. Yes, anytime you have, 95, 100 units deliver in a 1,000 unit submarket, it ultimately, you know, expands vacancy quite rapidly, although it's a small number of units that have opened their doors. So not nearly on the same level as your Nomas or your Capitol Riverfront or Southwest Navy Yard or things like that, but it is up there temporarily. But you'll see places like Bethesda and Greenbelt that are up there, more of that suburban Maryland piece of things. But outside of that, when you look past the 10 highest, most other submarkets are at 7% or below. So it continues to be certain pockets of the market that have been impacted most significantly from a supply standpoint and a vacancy expansion standpoint. So altogether, vacancies have been pretty steady over the past 4 quarters, but certain pockets are being exposed to shifting demand trends and a continual impact of new supply. So now let's shift gears and talk about that supply story, or excuse me, talk about the demand story before we go into supply. When we look at demand here, what you'll see is that demand increased in 2023. And when you look at the long-term average of the Washington Metro going back to 2006, the average is about 2,300 units absorbed on a quarterly basis. 2023 was the second year since 2006 to have all 4 quarters exceed that mark. In fact, the only other one was 2021. That's a pretty notable output, particularly when you look at the seasonality of things. Look at the third and fourth quarter, seeing demand continue to rise even above the first quarter. You just generally don't have that happen, right? So that was a complete role reversal from what we saw in late 2022 and ultimately lent its hand to offsetting a lot of the units that came online. So it was a pretty good year for demand. Now you could argue when you net out 22 and 23 in terms of the number of units absorbed, it came in at about 8,000, then 12,000 units. So altogether, you're at about 20,000 units. That still wouldn't keep pace with the rate of supply as an aggregate, but more recently you have seen it mostly keep up with the rate of supply. It's still lagging a little bit, but pretty positive trends exiting 2023 and into 2024 in terms of recent demand, despite the fact that we do see that job growth slowing from what we saw last year and 2 years ago. And the big piece of things is that it continues to be the upper echelon of apartments that are driving the bulk of the demand. What this slide is looking at is quarterly demand outputs in two pockets. First is the 4 and 5 star, and you can think of that as your Class A, any new construction, high price point, things like that. And 1, 2, and 3 star in the dark blue is your Class B or Class C. And what you can think of that as your, renter by necessity cohort, your more mature stock of communities, your, garden style, although black appliances are coming back in. It used to be a descriptor we could use, more of your more mature stock of inventory. And what you're seeing there is that over the past 2 years, it's been essentially flat or negative within that more affordable piece, but the more upscale piece of the market has been flourishing from a demand perspective. In fact, if we get rid of your lower your Class B and Class C piece and just look at the Class A, look what demand has done, particularly over the last 4 quarters. It's continued to rise. So it's clear that there's a flight to quality and renters are looking for that newest and greatest apartment if they can afford it. It's just a matter of keeping pace with supply. So when you look at this, you might think, well, what this likely means is that, vacancies are probably tighter in your Class A space versus your Class B and C, but it's actually the opposite. And while that might sound interesting, what you're looking at here is vacancy rate by cohort. And when you look at the 4 and 5 star piece, what you'll see is that really for the past 15 to 17 years, it's continued to remain above its 3 star and 1 and 2 star cohorts just because of the impact of new supply. There's a lot of supply that continues to open up its doors. And despite the, consistent demand over the past 15, 17 years from that Class A 4 and 5 star perspective, it still just can't keep pace with, the rate of new supply. Add on to that the fact that you really don't see any building taking place within that 3-star, 1 and 2-star cohort. In fact, those inventories typically decline each year because you have communities that are converted, demolished, or just, removed from the inventory set, and you don't have that impact of new supply exacerbating any sort of vacancy expansion. Rather, when you look at the end of 20 or mid 2022, like we talked about when it came to suburban Maryland, what you saw is vacancies were essentially at 15-year lows within each of those cohorts. More recently, they've expanded though, as we've seen that demand piece continue to soften, whether it's via evictions or, people, downsizing, going into other apartments, whatever it may be. There's been a more softening of demand, so vacancies have been increasing. So two different storylines taking place there. Another byproduct is units in lease up are above historical norms. In fact, by the close of 2023, there were about 9,000 units in lease up throughout the Washington metro. That's been a pretty consistent figure over the past 4 years. In fact, it's really fluctuated between 8 to 9,000 units, which is the norm. And when you compare that to pre-pandemic norms, it was about 6 to 7,000 units. So we continue to enter newfound categories of, different metrics throughout the Washington metro. It's now the norm where you have 10,000 units open each year, and we're likely going to see that continue. And the byproduct is you have so many units in lease up. But like we've talked about throughout this presentation, different pockets are more exposed. So when we look at the vacant units in lease up by submarket, what you can see is that, again, a lot of these submarkets that have a lot of the supply continue to be the ones with the most opportunities for renters, so to say, in terms of units in lease up. Anything in green is a DC submarket, and anything in dark blue is either, suburban Maryland or Northern Virginia. And what you'll see there is that H Street, Noma, and Southwest Navy are continue to have the most amount of units on a nominal perspective available for lease up. So a lot of opportunities, and it's a very you know, uh, competitive landscape in order to attract renters. That's why you're seeing the most amount of concessions in those areas. That 2 months free has turned into 3 months free, and it's very competitive. But let's compare that on an apples to apples perspective, because it's one thing to say, okay, there's 1,600 units in lease up in Noma. What does that look like in terms of percentage of inventory so that we can stack these up? Again, Potomac rises to the top, but it's also a very small inventory. So anytime you have 160 units in lease up, which is a pretty small number, all things considered, compared to its counterparts, it does look like a lot of its inventory is in lease up. But when you look at other submarkets like Noma, you have 10% of its inventory in lease up. That's a significant number. And then when you look at, Bethesda has 800 units in lease up. That's about 7% of its inventory in lease up. That's a substantial number. And you look at, Navy Yard at 5%. So what this really does is give you an idea of, on an apples to apples basis, where is that impact being felt compared to other submarkets when you normalize it for inventory. So certain pockets continue to lead others in terms of the impact of lease up that it's seeing. So now that we've talked about, market comparisons, talked about demand, let's go into supply, and we'll then lead that into rent. Supply. We've talked about this a lot, so we'll go through this section a little bit quicker to make sure we're staying on time here. But deliveries are holding steady at 13,000 units annually over the past 10 years. It came in above 13,000 units last year, and it continues to be the storyline, like we talked about at the beginning. So no surprise here in terms of what's been going on. And when we look at this and break it down, we talked about DC's 10.7% inventory growth rate over the past 4 years relative to markets. Let's look at that on a submarket level, because this might lend a little bit more granularity to the area. And this is a pretty telling story. When you look at Southwest Navy Yard and H Street Noma, like we've talked about a number of times here, those have both grown by at least 7,500 units over the past 4 years. The next closest, Brightwood Fort Totten, at 3,000 units. So they've more than doubled their next closest submarket in terms of the number of units delivered, which ultimately lends its hand to why it's been such a competitive market there, why vacancies are highest there. And when we get into rents, why rents really haven't been growing by much there because of the number of options that renters have. But when you get rid of that and you look at it, you have 3 DC submarkets at the top there. That's a lot of units. And when we think back to that vacancy slide at the beginning that shows DC pretty consistently being above its suburban counterparts, a lot of that reason is why. You have 54,000 units that have delivered over the past 4 years. And when you look at just these top 3 submarkets in DC alone, you come to about 17,000 of that just in those 3 pockets. When you add in the other DC submarkets, it's even larger, but it goes to show how many units have delivered in DC just over the past 4 years. And the multifamily pipeline is still packed, for the first time in about a year and a half, we've seen the total number of units underway dip below 30,000, but still, even just below 30,000, that's a relatively high number compared to history. And what that means is that we're likely going to continue seeing more years of at least 10,000 units open their doors. It's likely to happen at least this year, at least in 2025, potentially in 2026. So what that means is that we're not likely going to be out of it for another 2.5 years at least, because, given timelines and things like that, it's going to take a little bit for a lot of these units to filter out of the pipeline and for this to slow down. The one thing I'll add, though, is that we have seen that come down in certain places. So when we look at under construction by geography using the same three geographies of DC and the suburbs, what you're seeing is that DC's pipeline is held steady, but Northern Virginia has actually come down quite a bit, and suburban Maryland has too. Northern Virginia has gone from 12,000 units underway to about 9,000 units underway in the better part of the past year and a half. In fact, ground breaks have slimmed tremendously in Northern Virginia over the past year alone. A lot of that is because of the competitive nature of uses for land in Northern Virginia. When you think about, while office development certainly isn't anywhere near what it was this time 4 or 5 years ago, you have a lot of competition from the logistics side of things and more so from the data center side of things. So land is tougher to come by, and you have a lot of land banking going on. So a lot of firms holding on to land sites, particularly near transit-oriented development opportunities. So not as many units breaking ground in Northern Virginia or even in suburban Maryland, but still elevated pipelines across the board. And so what does that mean looking forward? When you look at the number of units underway, Southwest Navy Yard continues to be at the top, nearly 3,700 units underway in that portion of DC. And what that means is likely going to be a competitive landscape, at least for the next, 8 to 12 quarters to come, because, even when these units deliver, you still have to have the lease up. We talked about at the beginning, the number of units in lease up in Southwest Navy Yard alone. It's just going to continue to add to that cycle of options for renters over the next 2 to 3 years. So a number of units underway there, and is really just outpacing the rest of a lot of the places around Washington, including National Landing with 2,000 units underway. That'll be an interesting storyline to follow, particularly when it comes to 5 years from now with the Capitals and Wizards moving there and a lot of things going on in that area. So be interesting to see what takes place in terms of ground breaks in the coming quarters, if any, will take place in National Landing. The positives to take away from this, at least from a fundamentals perspective, is that multifamily starts dipped to 12-year lows in 2023. So for the Washington Metro, just under 11,000 units broke ground in 2023. And this is anything that, we're talking about concrete poured, they're underway, things like that. This is not just grading land and being ready to go. This means they're underway with a community. And at 11,000 units, that's dramatically lower than what we saw in 2022. So you can see the downward shift that has been caused by, the outright doubling of the cost to borrow capital and the shifting market conditions that make it, difficult to pencil out deals. So what that means is that as that 30,000 units underway continues to decline as units deliver and fewer units backfill that 30,000 unit number is likely to come down quite significantly over the next, call it 4 to 6 quarters, particularly if ground breaks continue to be slow. So we're right at about 33 minutes of the presentation right now, and we have 2 parts left. So we're going to talk about rents and then some outlooks. What have rents been doing? Well, we talked about how vacancies have essentially been flat for the past year or so. That's ultimately been a positive. And what's been going on recently is what this slide shows is the vertical bars represent your year-over-year change in asking rent as of that quarter. So what that means is to the left of that black line, you'll see that vertical bar there right around 3% means that rents grew by about 3% as of that quarter on a 4-quarter trailing basis. So by the close of 2023, asking rents grew by about 3%. And then overlaid on top of that is the overall asking rent for the metro, and that corresponds to the left axis. So what we're seeing is that, after a pretty slim output from a rent growth perspective in early 2023, largely because of the declines that we saw in the second half of 2022, as demand was pretty low and even negative in some cases. As demand bounced back, rents grew. When we think about that demand picture we saw with 4 consecutive quarters outpacing the long-term average, it really put pricing power back into the hands of property managers over the past 4 quarters. Now, We'll talk about different pockets of the metro because, like we talked about, places like Navy Yard, Noma, and other supply heavy uh, pockets have not been as fortunate from a rent growth perspective, but as an aggregate, rents have grown by about 3% over the past 4 quarters. That's a pretty good output for DC, particularly given what's taken place over the past 4 years. DC is a 2.5% rent growth market. So being right at there, it really speaks to, the health of the market despite the changes we've seen. And the question is, where do we go from here? We're actually going to release a new forecast in the coming days, and likely what we're calling for is less growth this year than what we saw last year. And the reason for that is we've seen job growth slow. It's likely to continue, or at least according to third-party sources, it's likely to continue slowing. There is concern surrounding, what that might do to the pockets of renter households. And the continual impact of supply can't be understated. Seeing another 10,000 units open up, 10,000 units open up, it just continues to compound itself and add opportunities. So what we're likely to call for is a sub 2% growth rate in 2024 with more room for growth in 2025. We've talked to, a lot of owners in the area too who seem to agree with that sentiment that this year looks a little bit more difficult from a rent growth perspective than what might be in 2025 as a rebound potentially ensues. So something to keep in mind is, might be a little bit more bleak this year in terms of rent growth. And so when we break out rents over the past 4 years, where have they been? This is looking at cumulative rent gains by submarket over the past 4 years. And what you'll see here is the top left is driven by a lot of your suburban sort of outlying areas. Frederick County, we talked about what population growth has been there over the past 4 years, and you're seeing that via rents. Rents growing by 25% over the past 4 years, basically coming in at about a 6% annual growth rate. And while a lot of that did take place in 2021, you can see how that compares to the bottom right. Look at a lot of the submarkets, and most of them are DC based. It's no secret that, from downtown DC outside of Bethesda, below there, it's been pretty slim from a cumulative rent growth perspective. When you divide that by four, obviously a lot of that hasn't been linear because a lot of this was pretty substantial losses in 21, followed by, or in 2020, followed by, outsized gains in 2021. But, rents just haven't been growing in the district proper because of the changes in population, changes in office using trends, and the number of units that have been coming online in a lot of these submarkets. So a lot of similar trends are likely to take place in a lot of these pieces of the market over the next 4 quarters. So keep an eye on that. And what this has meant for concessions is that when you look at the percentage of properties throughout the metro offering some sort of concession, it's continually been rising. And that's very interesting because when you look at just 2023 and see that up and to the right continual rise, despite the fact that vacancy has held pretty steady, gives you some sort of an idea of, you guys being boots on the ground, what you're seeing in terms of the, potential uneasiness in terms of, making sure that occupancy is boosted as much as possible leading into 2024 and the mid part of 2024 as more units deliver. Now, concession offerings are nowhere near what we saw in late 2020 amid sort of the second wave of COVID, and ever since then have been, trending anywhere between 10 to 20% over the past 2.5 years. But we have sort of seen this upward rise. It's been similar to what we saw in 2022. So there may be a chance that, as we get into the spring leasing season and the summer leasing season, you do see a decline in offerings, particularly as we get out of the seasonal months. But something to look, forward to in terms of the next couple of months is what concessions do as an aggregate. And this is very interesting when you look at the relationship between concessions and vacancy. The concession offerings are in yellow, and that corresponds to the right axis. So what you'll see there again on the far right is, that 23% of properties offering a concession, and the vacancy rate is overlaid on top of that. And the reason I do that is because it's not a one-to-one match by any means, but it's interesting to see the correlation and the ebbs and flows of vacancy in terms of what that means for concessions. And we'll talk about that in the forecast in a couple minutes because I want to just set the stage for what this might look like moving forward. So for our last 4 slides, let's just talk about capital markets and then an outlook, and then we'll do some questions. So unsurprisingly, when you look at the capital markets, deal flow slowed tremendously in 2023. It was hard to pencil out deals from a, cost of capital perspective and a return perspective. So by the end of the year, a little under 3 billion in sales took place, which was the lowest annual total since 2010. And just a couple figures in the top right to explain that. It represented a 64% decline in volume versus 2022 and a 73% decline versus 2021. So you did have a lot of slowing take place. But most interestingly, I was looking yesterday in terms of breaking it out by our three geographies we've been talking about over and over again: District, Northern Virginia, suburban Maryland. There wasn't any one area that saw a decline more so than others. What I will add is that, and this is very anecdotal, this is not a, CoStar endorsed thing by any means. This is just something we continue to hear. There continues to be concern surrounding the suburban Maryland piece of things. We're hearing that, investment firms, national firms are a little bit more concerned with suburban Maryland, purely due to the, rent legislation that has been implemented as compared to, concern levels in DC and Northern Virginia. I wouldn't say that's representative of every single shop, but it's something that has continued to gain steam and gain, traction in terms of things people are saying. So it'll be interesting to see what that looks like from an investment landscape, particularly if rates come down and deals are more readily pencilable in the next in the next, 4 to 6 quarters or so. So just something to keep in mind there. And then, when you look at the number of units sold, it dipped to 14-year lows. 11,000 units trading hands or changing hands in 2023 versus 29,000 and 41,000 in the 2 years prior. So when you have, a third and a fourth of what was trading over the previous 2 years, it goes to show you how much the landscape has shifted over the past 4 quarters when it comes to the capital markets in Washington. So I know we're right around the 40-minute mark of this presentation, and the last thing we want to do is leave you with an outlook before we go to questions. And what our outlook calls for right now is continual vacancy expansion over the next 2, 3 years or so. And the reason being is because you can bucket this into what I like to call knowns and unknowns. When you look to the right of that black forecast line, all of those blue bars up through basically mid 26, that's all known supply. That's all supply that's underway right now, barring any unforeseen circumstance, that's going to deliver. You can see where the model takes over and says DC has built so much, it has to come down. In fact, it comes down quite a bit in late 26. And while that might actually work out, it might come to fruition. We'll see, but it could line up with a lot of the slowing of construction starts that we saw. So not an unlikely scenario by any means. The difficulty or the sort of unknown is the demand side of things. It's been tough to keep pace with that number of units. And while we all are calling for, call it 10,000 units to open up in the next 2 years in each year, the slowing of job growth ultimately is impacting demand in this scenario, which is why vacancies are forecast to expand. Now, if there is more positivity from a job growth perspective in the coming months and quarters, and we don't see that slowing take place, there's a likely scenario that instead of vacancies expanding here, you could see them come down or even stay flat. But I do think that the impact of supply can't be understated, and it's likely going to lend itself to a little bit more vacancy expansion, at least in the coming quarters. And so what that means is that, as we combine our concession and vacancy piece of things like we talked about, again, we don't forecast concessions because there's a lot of variability with there. But when you look at concessions here, what you can see is you can see the vacancy line and see the relationship the concessions have had for the most part. Does that mean the concessions will go up? Well, naturally, if vacancies do rise, I would expect it to. So, just something to keep in mind as we go into 2024 and 25, what the impact of new supply could mean and what that means for rents. Again, we're calling for rents to slow a little bit this year and then have more of a rebound next year. And then, sort of stabilize in the outer years of the forecast. But it's going to continue to be a supply story, and the demand piece of things will ultimately hinge on what the economy does. So, excuse me, I know we're right around 43 minutes there. So what I will do is let me just take a look and see what we have from a question perspective and see if we can go through some of these.
Our chat has been surprisingly quiet. Does anybody have any questions that they'd like to unmute and ask of Mike? Not a one.
I don't know if that's good or bad.
Financing for multifamily project.
Sure. So that is a very loaded question in that there's a lot of variables associated with that. Obviously, financing has become very difficult to pencil out, and particularly when you look at it from both a borrowing and a rent growth perspective, because a lot of the deals, for example, that were acquired in 21 and 2022 were acquired with the hopes that rent growth would continue on. And, while it has been a pretty solid past 4 quarters for rent growth, rents aren't expected to grow as much as maybe they were underwritten to. Um, and ultimately, that's the reason why you've seen such a sharp drop off in the number of units that have broken ground over the past 4 quarters. It's just becoming hard to. Um, Community bank lending has slowed significantly, and you're seeing, lenders tighten the reins on what they have been lending on. So, it's it's definitely become more challenging, and I don't think I've heard from one person that financing is as easy as it was 18, 24 months ago.
Absolutely. Great topic. Thanks, Sammy.
I have another question for you.
Sure.
Sure.
So Washington is going through lots of challenges. We just heard that the capital will be moving to Virginia, and Washington proper downtown is being hit with a very tough commercial space that's being vacant, people working from home. Is the data you shared with us anticipate any impact of those two factors on possible vacancies or demand?
It's definitely going to be a tough situation. Just to give you so downtown DC right now has about 19 million square feet of vacant office space. That's just between downtown and the East End. And about 4 years ago, that was 12 million square feet. Add in, 4 or 5 years from now, what you're going to talk about in terms of, movement of the Capitals and the Wizards, and something that kind of not necessarily hides, but is potential relocation of the FBI headquarters to Greenbelt. That's only 2 blocks away from Capital One Arena. When you have the two of those at, one time potentially leaving, it could be a very, very, never before seen difficult situation down there. And the question is, it's hard to, we don't forecast flows of demand, saying, okay, if DC sees a lot of softening of demand, does it go elsewhere? We don't forecast that because it's very, independent of each household. But I do think that will impact the number of units that have opened within, call it a 2, 3, 4 mile radius of that area in the coming quarters if there aren't backfills, or if, the FBI does not stay. So I do think there is a lot more uncertainty in that area, potentially more than a lot of other places throughout the metro.
Thank you.
Mhm. In terms of out of the box concessions being offered to lure new prospects, right now it continues to be, new lease ups have continued to go into the territory of that 3 month time frame, where, it used to be years ago, if we went into 2 months free, that was sort of a newsworthy topic. I haven't seen anything in terms of on my end that's anything interesting or new outside of just look and lease offerings. Just trying to get people in there as quick as possible continues to be the thing. You are seeing an uptick in the concession offerings from a month perspective or a monetary perspective, but it's also the urgency that I've seen a lot of. That's, look and lease within 24, 48 hours, trying to bank on getting those renters in there as quick as possible.
Thanks, Adrian. Anybody else have any questions? I think you shared so much information with them. They're processing.
I know it's like drinking out of a fire hose. So I appreciate everyone's time. If, when you take a look at this slide deck, feel free to reach out. If any questions come up later today, week, whatever it is, give me a call, send me an email. I'm more than happy to discuss more of this, whenever you're free.
Absolutely. Well, thank you, Mike, for your time and all the great information today. And as we've mentioned, we'll send the recording as well as the slide deck out. Also, I know that some of your colleagues may have had issues accessing today's webinar. I've gotten a few messages that there was some sort of technical issue. So we are going to include those folks with the recording and the slide deck email as well. So if you have anybody who's reaching out to you to see if you got in and how it was, let them know that those materials are coming their way. And I sent them an email as well. And with that, I will set you free for the rest of your day. And I do hope to see all of you next week at Activate PMA. Again, we have a great program lined up for you. And don't forget about all those great educational programs that I mentioned earlier this morning. I'll include links in our email as well so that you can get registered for those. Thank you all for coming today. Have a great afternoon.
Thanks, everyone.
Thank you.
Thank you.